How high income earners can donate to charity to avoid paying taxes. Everyone already knows that you get a tax deduction for donating money to charities. In short, if you itemize, you get a dollar for dollar deduction for the amount you contributed to a charity of your choice. But that's not what this video is about. This video is about getting even more charitable tax deductions that stretch beyond the money you decided to contribute. Because the truth is that the ultra wealthy are not just handing money over to charities. Instead, they are using charities as tax shelters to park their money in and avoid paying taxes. For example, take a look at the Bill and Melinda Gates Foundation. Do you think they are saving money in taxes by setting up their own foundation to give money to charities? I'm willing to bet that they are. Oh, and they also have the Bill and Melinda Gates Foundation Trust. I wonder if that trust is helping them reduce their taxes at all. It probably is. Just read the next sentence here. It literally says that both entities are tax exempt private foundations. I mean, forget the rest of the sentence. The buzzwords are tax exempt. This means that the money they earn in these entities are exempt from taxes, like income taxes, capital gain taxes, and so on. And that's just the beginning, folks. There are several ways to use charities to significantly reduce your tax bill. And the truth is that these strategies are for everyone, not just the super rich who have great accountants to tell them to do these things. So today I want to walk you through the major ways you can structure your charitable giving to reduce your overall tax liability. Specifically, you are going to learn how to maximize your charitable tax deductions, how to use things like charitable remainder trusts to shelter income, how to use private family foundations to shelter income from taxation. And we'll talk about how you can use donor advised funds as well to shelter income. So if you're ready to learn more, go ahead and smash the thumbs up button for me below and subscribe to our channel for more great tax content. Let's go ahead and dive in. All right, so let's start with the basics. How do charitable tax deductions work? In general, you can get a tax deduction for the money you give to charity. However, the common problem is that you can only get this tax deduction if you take an itemized deduction on your return. And for most taxpayers, it does not make sense to itemize because their standard deduction is typically much higher than the itemized deduction, and you can't do both. For example, in 2023, the standard deduction is close to $14,000 for single taxpayers and $28,000 for married taxpayers, which means that if your itemized deductions are not greater than these amounts, then you will receive no added benefit for the itemized expenses you can claim on your return, like charitable deductions. Now, in addition to deducting gifts to charity, you can also deduct your medical expenses, local and state taxes paid, mortgage interest, and other minor expenses. But at the end of the day, if these deductions are not greater than your standard deduction, then it serves no benefit to you. But fortunately, there are ways to significantly increase your charitable donations without necessarily increasing your costs. And for the rest of this video, I am going to cover these strategies. So let's jump into it. Strategy number 1, donate appreciated property to charity. Donating appreciated property is the easiest way to increase your charitable contributions beyond your actual costs. Let me show you how with a simple example. Let's say you bought $5,000 worth of stocks. And let's say you struck gold and that investment turned into $100,000. Well, if you donated those stocks to charity, you could receive a $100,000 tax deduction instead of a $5,000 deduction. Now you might say, Sherman, there is no way I am giving $100,000 to charity. And I hear you on this, but we are going to build on this concept in a minute, so just follow me here for a second. You can take almost any asset like art, diamonds, real estate, and even business interests and receive a tax deduction for its fair market value instead of the cost you paid for it. There are literally firms that specialize in turning your cash into extremely high tax deductions based on this simple concept. For example, I know of a firm that buys commodities in bulk at a huge discount just to later get them appraised at a higher price to donate over to charity, and that saves them significant amount of money in taxes. And they even accept investors from ordinary people like you and me. So imagine giving $50,000 and in return, you get a $250,000 charitable tax deduction. To illustrate, if you were in a 37% tax bracket, this deduction would save you over $92,000 in taxes alone. So the question is, would you donate $50,000 to save $92,000 in taxes? And most taxpayers would say yes. Anyway, you will want to work with a good CPA that can walk you through strategies like this because there are various things to consider. And if you don't have conversations with your CPA about things like this, then consider becoming a client of mine at mycpacoach.com. Anyway, if you like this strategy, then trust me, you're gonna like this next one even more. So let's dig into it. Strategy number 2, set up a private family foundation. So what if I told you that you could get a $100,000 tax deduction by just giving $5,000 to a charity of your choice? Well, you could do this by simply setting up a private family foundation. A private family foundation is similar to a public charity, except it normally does not do anything other than give money in the form of grants. I like to think of private foundations like a charitable bank account. You can contribute money to it today and receive an immediate tax deduction. And then you can give money to charities of your choice over multiple years or even decades. Now, the main requirement is that you have to distribute at least 5% of the foundation's assets to charities each year. Let's take a look at an example. So let's say you typically give about $5,000 to charity each year, but this tax year you came into a whole lot of money. Let's say you made $1 million and you want to get some of this income off your back to pay less taxes. So you decide to set up a private family foundation and decide to put $100,000 inside of it in 2023. This means that you would get an immediate $100,000 tax deduction in 2023. Then all you would have to do is give about $5,000 or 5% to charity each year. And since you already typically do this, then all you have really done is put money aside for your future charity donations over the next 20 years. Plus that $100,000 deduction that we just took would put at least $37,000 in tax savings right back into your pockets if you are in a 37% tax bracket. But there's more. In addition to the charitable tax deduction, there are a few other major tax benefits of private foundations. Number 1, you can invest assets in your PFF, and any income generated is subject to extremely low tax rates ranging from 1 to 2%. Number 2, you can hire your family members and pay them reasonable fees, which is deductible from the required 5% distribution you have to make each year. And then number 3, you can also use your PFF to pay for travel expenses for board meetings, which may include your family members. Those expenses are also deducted from your required distributions each year. And then number 4, your PFF can live forever and be passed down to family member after family member for generations and generations. But like anything that sounds too good to be true, of course, there are some cons. The obvious first con is that you have to distribute at least 5% of the assets each year, and if not, you could face some major penalties. The second major thing is that you can't engage in self-dealing transactions, or in other words, can't just take money out of your foundation for any reason. When you put money into a private foundation, you should expect to not get any money back from it other than some minor compensation for services you or your family is providing to it. And there are several rules about what type of services you can actually receive compensation for. So just be careful. You can get into some big trouble if the IRS think you are engaged in self-dealing transactions. Anyway, if you desire simplicity, then the next strategy may be for you. Strategy number 3, set up a donor-advised fund. A donor-advised fund allows you to get a charitable tax deduction today for contributing money to charities at a later date. It is very similar to private foundations, except it is much easier to set this up. You don't have to set up a new entity or get a bunch of lawyers involved to set up a donor-advised fund. Instead, you can simply go to a financial institution like Fidelity, open an account, transfer money, and receive an immediate tax deduction for the money you contributed. Then you can advise the fund on when to actually distribute those funds to charities of your choice. So although you're getting an immediate tax deduction for your contribution to the fund, you can distribute money to charities of your choice over several years. Now, of course, there are going to be some cons, so let's talk about it. Number one, you have less control. Technically, when you move your money to a donor advised fund, you are no longer in control of those assets. Instead, the fund is, and legally, they can invest those funds without your permission. Number two, no salaries. Unlike private foundations, you cannot pay yourself or a family member a salary or fee for any work they performed in the fund. It's not theirs. Number three, this also means no additional deductions. You cannot deduct expenses from the fund, like travel expenses, for example, like you can with private family foundations. But if ease and simplicity is of interest to you, then a donor advised fund may be a great choice. Now let's move on to another tax shelter for charitable donations. Strategy number four, set up a charity remainder trust, also known as a CRT. So what if I told you that you could move income generating assets over to a trust, receive a charity tax deduction, and pay no income or capital gains tax on the assets in that trust? And what if I told you you could also pay yourself from this trust too, as long as you give the remaining assets over to charity when you die? If that's something that you would be interested in, then you may want to consider setting up a charity remainder trust. This is one of my favorite vehicles to use to reduce taxes. A charity remainder trust is a tax-exempt entity with some great tax benefits. So let's go through each of the key tax benefits. Number one, you can move assets out of your name and into the trust. And when you do this, you get a charitable tax deduction, even though this money has not even went to any charity yet. And number two, because the trust is a tax-exempt entity, this means that any assets that generate income or capital gains are also exempt from taxes. So in the case where your stock portfolio exploded and you wanted to avoid capital gains tax, you could simply transfer those stocks into your CRT and avoid capital gains tax when you sell it. The same goes for businesses. If you transfer your business into your CRT, you would avoid capital gains tax when you sell the business. And the third key benefit is that you can control and invest the assets in the trust. And more importantly, these investments grow tax-free. So you could technically sell assets, pay no taxes, and buy other assets that generate income and still pay no taxes on those assets as well. And the fourth key benefit is that you can pay yourself a fixed percentage or dollar amount from the trust assets. And you would only pay tax on the money you are receiving from the trust, not the money that the trust earns. Let's say you're going to sell your business for $1 million. And if you do, you would pay at least 20% in capital gains tax, which is equivalent to $200,000. But let's say you don't want to pay these taxes, and you also don't need that much money at once. Maybe you only need a portion of that to sustain your lifestyle while you are still alive. So you decide to transfer your business to a charitable remainder trust instead. And once it is sold, inside of the trust, you would save those $200,000 in capital gains taxes and instead pay nothing. Then let's say your trust allows you to take 5% out of the trust per year as a payout, which again would pay you around $50,000 in the first year. And that $50,000 number is the only amount of income that you would pay tax on. In addition, remember, you will also receive a charitable tax deduction for the expected value of your donation to charity at the end of your life or trust term. And that is how you can avoid taxes with a CRT. Now, these tax benefits do come at a price. The most notable con of CRTs is that they are irrevocable, which means that anything you contribute to the trust cannot be taken out outside of the payout percentage determined when setting the trust up. Also, keep in mind that what is left is going to charity. So this may also impact your estate plan and how you plan to give assets to your children when they are gone. Now, there are workarounds for almost every scenario. So if you're interested in a strategy like this, make sure you consult an experienced professional who can guide you through these types of decisions. And if you want me to create a video that goes more in detail about this, comment below and I'll consider doing so. So look, at this point, I have given you 4 very powerful ways to increase your charitable contributions without necessarily increasing the cost of those contributions. By incorporating any of these into your tax plan, you can increase your charitable deductions in a way that allows you to take the itemized deduction and save more money in taxes. And you may also be able to use some of the strategies mentioned to avoid some major income and capital gains tax along the way. So if you enjoyed this video, drop a comment and let me know below. And if you want a comprehensive tax plan that is literally guaranteed to reduce your taxes, consider applying to work with me directly at mycpacoach.com. As always, thank you for watching, and I look forward to seeing you in the next episode.